Hello and welcome. Welcome to the Red Wagon Estate Planning and Elder Law Show, hosted by me, yours truly, Jeffrey Belomo, where we discuss all things estate planning and elder law. And, well, hey, anything else we want to talk about. Now, on today's episode of the Red Wagon Estate Planning and Elder Law Show, we are going to talk squarely about estate planning and elder law. The plan for today is I'm going to talk a little bit about some of the updated tax and Medicaid numbers. And then after I complete that, we're going to talk a little bit about choosing an attorney for estate planning and elder law versus going with a church or going with a financial professional who does estate planning. And we'll talk a little bit in detail about the pitfalls of those and why an experienced estate planning attorney makes sense in this area. So before we begin, as always, I want to start with our disclaimer and just a reminder that anything that you hear on this show or any other show is for informational, educational, and entertainment purposes only and should not constitute legal advice. If you need legal advice about your specific situation, please contact an attorney licensed in the state that you reside in who practices in the area of law that you are looking for advice in, and meet with them discussing your specific situation, and then you can get legal advice regarding your specific circumstance. All right. Now, a reminder, at Belomo & Associates, we offer free educational workshops on a weekly basis. We have free educational workshops in the area of estate planning or pre-planning, as well as crisis Medicaid planning. Also, we have life care planning workshops, post-death administration workshops, and special needs workshops. We educate at Belomo & Associates, so what happened to my family does not happen to yours. We will provide free educational advice. We'll give you information and be able to teach you all about those area of the laws, discuss the fees and structures up front, the pros, the cons, the goods, the bads, and the uglies. And then if it makes sense for you to hire our firm, we would certainly be honored and would love to do that. If you would like to learn more about our upcoming workshops, please reach out to the office at 717-845-5390. Or check us out on the web at www.belomoassociates.com. That is B as in boy, ELLOMO, associates spelled out with an S.com. We would certainly be honored and humbled to be able to educate you in those areas of the law. All right, so just a quick reminder, we are starting 2025, which means that there are some new tax numbers that have come out. Now, as it relates to estate planning and elder law, the numbers that we are most interested in and that have the most sort of relevance to what we are doing are the estate and gift tax numbers. So this year, in 2024, the current annual exclusion amount is $18,000. In 2025, it was going to $19,000. And the exemption amount is going from $13.61 million to $13.99 million. Now, let me explain those numbers for you. That means that an individual can die with $13.99 million and not have to pay any federal tax. If they are married, it is an additional $13.99 million in the year 2025. That also means that that individual could gift during their lifetime $13.99 in 2025 because that exemption amount is during life or at death or a combination of both. So you could give some during life and some at death. Now, for the majority of our clients generally do not have anywhere near $13.99 million. I would say for the majority of our clients, they are somewhere within the range of, $400,000 to $500,000 to maybe $3 to $5 million. So we generally do not have the clients that have the $13.99 million type of wealth. And therefore, for the majority of our clients, if they got advice and if they worked with their financial professional, their advisor, their insurance agent, their elder law attorney, their accountant, and it made sense to them, they could theoretically give away all of their wealth at no tax consequence because of the $13.99 million exemption. Now, I'm saying theoretically, all of that, because if you have listened to any of my podcasts or you have come to any of my workshops, you know that I think that is a horrible idea. I think gift is a 4-letter word. I think it's a bad word. I'm not suggesting that we do it. I am merely teaching us what the current exemption amount is. So that means that a person can give away in 2025 $13.99 million. Again, during life, at death, or a combination of both. Historically, the reason that the annual exclusion gift came into existence was because the government had the federal estate tax limit at $600,000 at one point, and then at $1 million at another point. It has gone up since then, and certainly is to numbers that are much higher now. But when it was at $600,000, the dilemma that the government faced was, how do we allow individuals to give birthday gifts, to give Christmas gifts? How do we allow them to do those things when theoretically that counts against the $600,000, because you can give that away during life or at death? So they created the annual exclusion amount to give individuals, I think it was 10,000 when it started. Now it's up to 19 in 2025, meaning in 1 year you could give up to that amount of money away for birthdays, for Christmas, for just random whatever to any individual. And you didn't have to report it. You didn't have to do anything with it. There was no issues with it. That was essentially the way to give away those gifts and to do things for family members. Now that we're at a currently $13.61, soon to be $13.99 million exemption, in theory, the annual exclusion gift really isn't as important, doesn't have nearly the teeth that it used to, because, like I said, most clients of ours could give away everything and not have to worry about using that annual exclusion gift. For people who do have the kind of wealth that they may be over that, the 13.99, sure, giving away the annual exclusion gift every year might make sense. But as I've pointed out in other podcasts, because of the 5-year look-back period in long-term care land, many of you who have listened to the podcast know that I do my 3 lands, and long-term care land is one of my lands. You have to be very careful using the annual exclusion or the exemption amount, because in the 5-year look-back period, they will see that, and that will count towards a gift and will be penalized, which I will explain in a few minutes what the new penalty divisor number is for Medicaid. So it all has to come together. All of this has to be taken as one whole. You need to get advice specific to your situation, but I wanted to just give the updated numbers, and that is for 2025, the annual exclusion gift is $19,000, and the exemption amounts are at $13.99 million in 2025. So that's your tax update coming into the year 2025. As far as the Medicaid numbers in Pennsylvania, I'm just going to run down all of them. Not all of them changed, but I always like to do this once a year just to kind of give an overview of the Medicaid numbers as well. Again, this is specific to the state of Pennsylvania. So first things first, a person in Pennsylvania can be qualified for Medicaid or medical assistance, and they have to be spent down to a certain amount of assets. That is either $2,400 or $8,000. That depends on the amount of income that an individual has. So, starting in 2025, the number is $2,901. So, if a person's income is greater than $2,901, they can have $2,400 in assets. If it is less than $2,901, they can have $8,000 in assets. Now, we have a complete crisis Medicaid workshop. We have the ability to send the link so that you can understand Medicaid and what it is. I am just simply providing the numbers for 2025. So if you're listening to this and you're thinking, I don't know what those numbers mean, please feel free to get yourself educated. It will cost you nothing so that you can understand all of that. All right. So once a person is on Medicaid, they are allowed a personal needs allowance. Currently, that amount is $45 and has been for a while. It is going up to $60. So that's the amount of money for a person who is on Medicaid to get their hair done or to do things for themselves. so that they have that in their account. That number is finally going up to $60. In a married context, when we have a husband and wife, the community spouse or the individual who is residing in the home is allowed to keep a certain amount of assets. Now, there are some exempt assets like a house, a car, the community spouse retirement account, but essentially everything else is put in a pot. That pot then is added up, and the community spouse can keep half of that pot, no less than $31,584 and no more than $157,920. So if the individual has $500,000 in the pot of available resources, half of that is $250, but that is greater than $157,920. And as I said, the maximum that the community spouse can keep is $157,920. Similarly, if an individual had in that pot of money $50,000, half of 50 is 25. However, the minimum amount is $31,584. So we will allow the individual to keep $31,584, which is a little more than half, which would have been 25. On the income side, a community spouse, we want to make sure that they're not impoverished. We want to make sure that they have some income. So if the community spouse's income is not at a minimum of $2,555, they will be allowed to keep a portion of the IS or institutionalized spouse's income in order to get them up to the minimum of $2,554. The maximum triple MNA or minimum or maximum monthly maintenance needs allowance, in this case, maximum is $3,948. When we look back 5 years, what we are looking for are gifts. If we find a gift that appears, the penalty divisor, so that we determine how many days the individual will be ineligible for Medicaid, will currently be $3,999.80. So you divide the total gift by 399.80, and that tells us how many days the individual will be ineligible for Medicaid. So just a quick reminder on the 5-year look-back period. It is not a 5-year penalty period, right? It is a 5-year look-back period. That means that for the 5-year period preceding the day that you file a Medicaid application, we will put all of your bank statements in a box. We will then go through the box and we will look at all transactions in the state of Pennsylvania. Again, I'm just focused on Pennsylvania, that are greater than $500. If something occurred that is greater than $500 and they look at it and they say, yep, it is a gift, you gave it to someone and did not receive consideration or something in return, such as paying for services, legal services, or buying a widget, that is okay. Giving it to your son or daughter or to the church or to another family member may not be okay. If that amount was greater than $500 in a month in aggregate, they will divide that by the penalty divisor to determine how many days the individual is not eligible. With the home equity, the minimum is $730,000. The maximum is $1,097,000. So that's if a person, I told you that this community spouse can exempt a home. What is the minimum amount of equity that they will allow you to exempt? That is $730,000, and the maximum is $1,097,000. Those are the biggest, what I would say, numbers that we use and pertain to in the Medicaid context. A few others that are there that I just wanted to give the numbers. The home maintenance deduction is $989.10. The heating standard is $750. Non-heating, $401. The excess monthly is $767, and the Medicare Part B is $185. Again, if you're listening to all of this and you're thinking to yourself, I'm not really sure I understand any of that, that is okay. We do have Medicaid crisis workshops that we can educate you. You will get a consultation with a team member to allow you to get more information and learn a little bit more about what that means and how it would pertain to you and your specific context. All of that information is specifically related to if an individual in your family needs long-term care in the home or in a nursing facility, and you're trying to figure out what that looks like. That is why you would want to come to the Medicaid Crisis Workshop. And these updated numbers are what will pertain to 2025. One more comment before I move on about selecting an attorney that I meant to mention when I was going over the tax updates. We are currently expecting at the end of 2025, according to the current rule, for the current tax rules to sunset or to basically go back. Now, what that means is that in 2026, the federal estate tax limit, I told you, is currently in 2025, 13.99 million. It is set to go back to 5 million plus inflation. So we're expecting the exemption in 2026 to be somewhere around $7 to $8 million a person. Now, that has not been put out yet because we're not in 2026 yet. We're just heading into 2025. So what is happening is a lot of people are calling into the office wanting to discuss about taking advantage of the $13.99 million exemption so that if it does go back to, say, 7 million in 2026, they haven't wasted the exemption, that they're able to take advantage of it in the year 2025. Quite possibly a good idea, but what I am saying and kind of really trying to yell at the rooftops here is if it were me and I had that kind of wealth, I would not be rushing out yet to be giving up control of my assets. The only way to get assets out of a person's estate for tax purposes is to either give it away or to give up control of it completely. Now, I can tell you from experience, back when the federal estate tax limit was $1 million, a lot of people gave away money or put money in trust that they gave up control over, and they are regretting it because as the federal exemption went from 1 to 3 to 5 to now 13.99 in 2025, people with only $2 or $3 million gave up that money to try to take advantage of the federal exemption amount to avoid what was then a 55% tax. But then as soon as the rate started to go up, they realized, oh, crap, I gave up control of this money and I can't get it back. What can I do? So I'm taking a similar sort of line of thinking, which is if that is something that you need to take advantage of because you have more than, say, $8 million, and then if you have a spouse, more than, say, $16 million, yeah, you should probably be talking to your professional in the year 2025 to discuss it. But I wouldn't be implementing it until we got closer to the end of the year when the new Congress, House and Senate take effect this year. Who knows what will happen? Who knows if they will change it? So I wouldn't be giving up control until I knew that was a sure thing, that it wasn't going to change. Also, in order to take advantage of the current $13.99 million, you would have to have that money or more. So if you're a husband and wife, you would need to have, say, 20 million plus in order to be able to take advantage of it. If you're a single individual, you probably need more than 10 million because we're expecting the exemption to be at 7 to 8. You'd have to probably use at least 10 to make it worthwhile, meaning you have to give up control of at least 10 million, or a married couple at least 20 million, in order to take advantage of the current exemption amount. I don't have any clients that have that kind of wealth that would be looking to give up control of that amount of wealth to take advantage of the current exemption amount. I'm sure they're out there, and I'm sure that they will be getting great advice from their professionals. But for the majority of our clients, they don't have the excess wealth to try to take advantage of the current exemption amount, giving up control of it. And it just doesn't apply anyway for most of our clients. Which brings me to another topic that I want to talk about today. It's a very interesting thing. I've mentioned it on a previous podcast, I believe once, but it has really, really, really kind of taken legs recently. And I thought I would touch on it one more time. I was talking to a friend of mine who is a financial professional, and he and I kind of both do a lot of workshops, and we were just kind of going back and forth on the workshops and how they work for us and what we're doing. And one of the things that he said was that he works for a direct mail company, and he is a financial professional. And the direct mail company does all kinds of research on what are people responding to? What are people kind of listening for? What are they showing up for? And the research company that a lot of financial professionals use, their research is showing that the estate planning topic is a topic that people are interested in and that they will show up for. So this direct mail company is encouraging the financial professionals to do estate planning seminars to bring people in. So there are a lot of financial professionals that we have relationships with that have asked us to come in to do joint workshops with them, which makes complete sense, right? We focus on the estate planning side, they focus on the financial professional side, and it's a win-win for both our company, their company, but also for the clients, because now you're working with individuals who are in their skill set, who are doing what it is that they do well. And I don't know whether estate planning is a topic that people listen for or not, but I do know that because this company is telling financial professionals that, they are now really focused. There are a handful of people who are in the financial services arena who are hosting estate planning workshops. And it will actually say right on the invitation, this is being hosted by a tax professional. They are not an estate planning attorney. They are not a licensed attorney. They are not somebody who has experience in estate planning. It says it, there's a little disclaimer right in the invitation. So it's not as though they're hiding it, but they're using the estate planning word, the buzzword estate planning, to get people in a room. A lot of them are providing meals to get people to come in to listen to the knowledge, to listen to the estate planning. So I reached out to a couple of them saying, hey, it would probably make sense for us to do joint events like I do with other professionals so that I can focus on the estate planning side, you can focus on the financial planning side. And one individual specifically said to me, I have no interest in that. I don't want people to be confused and to be deluded by estate planning. I'm trying to sell annuities. I'm trying to get them to buy annuities. And if you start talking about estate planning, it's going to derail my entire process and getting people to come into me to do annuities. I said, yeah, but you're advertising that you're doing an estate planning workshop. You're actually using my copy and talking about wills and powers of attorney and asset protection and how to preserve assets and how to avoid probate. And he goes, yeah, and I mentioned that a few things, but then we talk about annuities and we get them to come in for a consult to be able to sell annuities. And I'm afraid that if you really start talking about estate planning, it's going to derail them. And I said, well, what are you going to do when people actually want to get a will? Well, I have a form that I use and I just do the will so that I can focus and get them into the annuities. It was one of the most eye-opening experiences of my life. And I am not suggesting by any stretch of the imagination that the individual was a bad person. Not at all. In fact, I like him a lot. What I learned from the experience was that because these companies, direct mail companies, are telling people that that's what people are showing up for, they are literally using it as a way to get people in a room to sell a product that has nothing to do with estate planning, that is completely a financial product. And in fairness to them, they are saying that they are financial professionals and not estate planning attorneys. So what I just want to reiterate is to pay attention to who is teaching the workshop. And if you're going to an estate planning workshop and they are glossing over estate planning and they're giving you some form, which in the case of the individual that I looked into, they work with an attorney in Nevada. Now, I'm here to tell you that the rules in Nevada are very different than Pennsylvania. And while the documents may work, it's certainly not a guarantee. It's certainly not going to be easy for your family. I just wanted to put it out there to pay attention to what is the copy of the advertising and is that what truly the person's specialty is. So how would I find an experienced estate planning elder law attorney who really focuses in that area. As I mentioned, we work very closely with financial professionals. In fact, we work with hundreds of financial professionals, especially over 20 plus years. And it works out great because we both focus in the area that we are good in. But when you're attending a seminar that is put on by a financial professional with the topic of estate planning and they are not licensed, only licensed attorneys can practice law. Practicing law is drafting estate planning documents, putting plans together for avoiding probate, asset protection, all of the things that we do. I am not a licensed financial professional. I have always been very adamant that I will not be and that I should not be because I believe that it's a conflict. I don't believe that an attorney should be licensed selling you financial products. Similarly, I don't think that a financial professional should be trying to teach you or have you do estate planning with them when that is not something that they do. So I just wanted to put that out there. The other thing that we have noticed that's occurring a little more than it used to is that church organizations are partnering with companies from other states to be able to provide estate planning for their constituents. In some cases, it's free. And the reason that they're doing it in some cases for free is because as part of it, they're trying to get the consumers to provide donations to the church, which certainly I'm all about charitable donations and want to assist the local churches. The problem is that the documents are not typically Pennsylvania. They are from other states. Again, their real need is to try to get more money for the church, which is why they're offering it for free for the consumers. But again, I would say if it's not what they specialize in, if it's not what they focus in, your family, transferring the wealth, making sure that it's protected, making sure that the money is there, making sure that you don't lose it to a long-term care, making sure that your kids don't lose it after death. That's important stuff. And doing it cheaply or for free and using a form that somebody has from another state is very, very dangerous. And it can really, really cause emotional stress and problems to your family if that is not done correctly. So what I would recommend when looking, really try to find someone in your area or in the state that you reside in who does it for a living, who does it all of the time, whose focus area is estate planning and elder law. I would ask them, how many asset protection trusts have you done? How many Medicaid cases do you do on a regular basis? If it's not a significant number, then they don't specialize in that area. One easy sort of initial litmus test that you can use is look to see if the law firm has a certified elder law attorney. It is a very, very difficult exam to pass. It requires several years of experience on top of a lot of focus in different areas of elder law and estate planning and tax planning. So it would certainly tell you that the individual has practiced for a while in this area specifically, and then that they were able to take a very difficult exam and pass it. I know when I took the exam, it was a 19% pass rate. I have not looked recently to see what the current rates are, but it is a very difficult exam. That will at least tell you that they've done it for a while. They were able to sit and pass an exam, at least as a base to start with. And then I would really look into their reviews, look into how long have they been around? Are they an established firm? Is it a one-man person's firm? What happens in that instance if something happens to them? What is their backup plan? Those are all things that I would really be looking into. But the first thing is look for a licensed attorney, then look for someone who does it on a regular basis, then look to see if they're certified, then look at their reviews, talk to people who have worked with the law firm. I think that those would be great ways to truly get an understanding of if that firm or individual really is the person who specializes that you want to be working with. I think one of the most important things that you will ever do in your life is plan for your family, making sure that they are protected today and tomorrow. Don't take that lightly. Don't leave that to a financial professional who is really just trying to sell a product, who doesn't know the first thing about estate planning, who got a form. Work with someone who does it all the time. As you can tell, I'm very passionate about this. That was a very, very telling conversation that I had. I wanted to share it. I wanted to give a little insights. I hope that you enjoyed this episode of the Red Wagon Estate Planning and Elder Law Show. I certainly loved being with you today and spending some time with you. If you're looking for information about Bellomo & Associates, please check us out at www.bellomoassociates.com. That is B as in boy, ELLOMO associates.com. I thank you very much for being here with us today. And until next time, see you real soon.